All right, well, my next guest says the critical element for the direction of the markets is the outlook for economic growth. Jeff Palma is a global equity strategist at UBS. He joins us now, and John and Sheila with me as well. And Jeff, you know, looking at this morning, okay, you've got the yields on the 10-year back down to the lowest level in April 2009. If you were an equity investor, though, would you be more nervous?
Well, I mean, bond yields are obviously telling you something about concerns about growth or uncertainty about the world. So to the extent that bond yields are very low, I mean, it seems to me that, you know, from our perspective, the overall outlook for growth is not nearly as bad as what bond yields are telling us. And so in some sense, no, I don't think equities are supposed to be more nervous than they are. But it's pretty clear to me that uncertainty in equity markets is also quite high right now.
But why do you think the bond markets are wrong?
Well, I mean, I think there's a lot of things. I mean, number one is the Fed has told us, you know, pretty clearly that they're going to be on hold for a little bit while longer. I mean, I think at the earliest, our call is that the Fed is going to be raising rates in January. So there's that. Number two is growth is kind of weak, and we've certainly seen some disappointing economic news of late. There's no inflation concerns, and in that sense, those are all things that are holding bond yields down. But in the end, we think we're going to get higher payroll growth. We're going to get a sustainable economic recovery, and if those things are true, it seems to me bond yields are probably too low.
If that's the case, Jeff, let's talk about sectors. We know a lot of people in the stock market have been hiding in some of the defensive names. I know you're cautiously optimistic on those names that benefit from an improving economy, but what's the split? How much in defensive, how much in the ones that maybe are a little bit more risky?
Yeah, I mean, our sense is that equities can still move higher over the course of the year, that valuations are in a pretty reasonable spot, and that with earnings growth, you'll get paid for taking some equity market risk. But that uncertainty does suggest that this should not be a purely positioned cyclical portfolio. We've got technology as an overweight, but at the same time, we also have consumer staples and healthcare as overweights in our portfolio. So it's pretty balanced even for a constructive equity view.
Jeff, it's Sheila Dharmarajan here. A big part of that global growth outlook has to do with earnings, which is we're coming up on earnings season in just a few weeks. I know you said before that earnings expectations are looking a little high, perhaps a little frothy. What sectors are you concerned about the most?
Well, I would point out that the 2010 expectations, I think, are pretty realistic. And there, the news is great. We're expecting 30 to 35% earnings growth for the world and actually most of the regions this year. It's those 2011 numbers that concern me a bit more. They're predicated to get that 20% growth that's forecasted. They're predicated on extraordinary margin expansion. And for us, most of that risk is within the more cyclical sectors. The defensive sectors have all growth below 10% forecast.
And Jeff, real quickly, is this volatility here to stay? Is it going to stay this way for a while?
Well, I think uncertainty is here to stay. Now, whether that translates into equity volatility is a slightly different story. I think we will be in a slightly elevated volatility environment, call it in the mid-20s on a reading like the VIX. But that's all consistent with all these macro uncertainties. A low-growth world with fiscal rebalancing, concerns in Europe, debt issues, that doesn't really translate to a low volatility, low uncertainty environment.
Jeff, we'll leave it there. Good to see you again, as always. Jeff Palma, the global equity strategist at UBS.